Welcome to the Day Trading for Beginners podcast. This is season 3, episode 8. And in this episode, I want to go over the 7 biggest mistakes new retail traders make and how to fix them. So my name is Tyler Stokes from StokesTrades.com. I have been on a journey to become a full-time day trader, and I'm currently trading a momentum trading strategy. So below in the show notes, you can find links to our school group. In that group, I've got a few videos that describe the strategy that I am using. And I'm currently doing a trading challenge where I'm outlining all my trades and doing a portfolio reveal at the end of every month. So you can find links to my trades, my portfolio highlights, and our school group below in the show notes. But here in this episode, I want to talk about some mistakes because, I've been trading for 2 months. I've made some of these and I want to sort of highlight them and allow you to become aware of them. So if you're not trading yet or you started to trade, just being aware that these things exist is going to help you when you actually start doing them. So for instance, overtrading. If you didn't know that that was a thing and you started to trade and you start overtrading, you won't even realize what you're doing until you just keep making mistakes and you continue to lose money. So I think awareness is really important for a lot of these things. And then you will have to sort of experience them, make these mistakes, and then say, hey, I'm doing this thing that's wrong. I know that it's wrong. And then you can try and fix it. So one of the big things that we should agree upon right from the bat is that when you're trading, you are going to mess up. You're going to make mistakes. This happens no matter what you do, especially with trading. Losses, they are a part of the game. So you can kind of think of them maybe as like a tuition for learning the markets. You are going to make mistakes and you're going to learn, you're going to lose. Every trader, newbies to pros, we take some hits and some losses. But, if you can shine a light on the biggest pitfalls before you stumble into them, you're going to be better off. So, imagine making fewer mistakes, losing less money, and building confidence faster because you are aware of what to avoid. So awareness is the first step to mastery. So in this podcast, we're going to break down 7 common mistakes that beginner traders make, mistakes that I've made, and try and give a few tips on maybe how to dodge them when you do come across them in your own trading. So we're talking emotional traps to chasing bad trades. You're going to learn how to potentially protect your account and be smarter. So let's jump right into it. And the first one here is letting emotions take control. So emotions are a trader's worst enemy. Fear makes you sell too soon when a trade dips, and greed or FOMO, fear of missing out, pushes you to buy when prices are, sky high. As retail traders, everyday folks like you and me with smaller accounts, we are especially prone to these emotional swings. I felt personally the panic of a losing trade set in when the price drops, and I felt the rush of jumping into a stock when I see it spike. And what that does, it just leads to bad trades. Now, big players like, institutionals, big companies, whales, and so on, they count on this emotional side of the retail trader. They know that we're going to panic sell during dips, or we're going to FOMO buy into these breakouts, and we create a bit of liquidity in the market for their big trades. So our predictable reactions are their opportunity. So we don't necessarily move the market, but when we are emotional, when retail traders are emotional, they listen to news narratives, there's bad headlines, and they start trading with those. It creates liquidity in the market that these big whales and institutions can take advantage of. So a mistake that I've made, just being impatient. I was emotional with certain trades. I ditch certain trades too early if they didn't move fast enough, missing out on profits that I planned for. So how to avoid this? One way would be to, have a trading plan or write a trading plan for every trade, every exit, every stop loss if you set those up, and then follow it. So, having a strategy and sticking to it no matter what you are feeling. If you keep a journal to track your emotional triggers, that could help. If you're feeling impulsive, you need to step away from the charts. So if you have a way to kind of journal or write this down, that could be good. An easy solution might be to share all your trades in our community on School. So personally, I've been doing that. I've been documenting every trade that I've taken in the trading challenge, and it's forced me to stick to my strategy because I have to sort of publicize my trades. So it's very easy to make a bad trade and not tell anyone about it and hope that, it kind of goes away. But if I'd have to document every trade and be honest about it, then I'm more likely to not get emotional. At least that's been the experience for me. So consider joining our group. And when you start trading, just share your trades, journal them in our community. That could be useful. Number 2 here, chasing breakouts into traps. So, if you picture a stock smashing through a resistance level with huge volume and you think it's going to go higher and you buy in, then the price reverses, leaving you stuck. So this chasing breakouts, it's a trap that beginner retails fall into. I've done it before as well. Breakouts look like opportunities, but they're frequently setups by big players. Now, part of this strategy that I'm talking about kind of has to do with the strategy that I am trading with. So I'm buying the back test after breakouts. If you're day trading or you're trading on smaller time frames, then sometimes this particular one might not apply to you. But the main consensus here, the main thought is that when things break out, they get pushed up to resistance levels, sometimes all-time highs. That's when retail traders tend to buy in, and then the price retraces and they panic sell. So we don't want to do that, at least for the strategy that I'm following. I don't want to chase breakouts. I want to just buy the back test of a breakout. So the market, it thrives on patterns, breakouts, pullbacks, retests, because human behavior is predictable. So when we rush into breakouts, we push the prices up just enough for the whales to sell. And when prices pull back to test support, we panic sell thinking it's over, it's going to go lower. And this sort of buy high, sell low cycle, it's a beginner's mistake. And I think many first-time traders fall into it. Personally, I've done it over the years as well. So I used to, want to chase on green days. Everyone wants to buy on green days, but buying when the stocks are soaring because it feels safe. That's why people buy. When the stock's up 5%, you just want to jump on for the ride. But, if you do this over and over, you end up buying at peaks or you buy in a range, and it's generally not a good strategic move. And then when things drop, sometimes people panic sell. So it's really a bad cycle to get into. So to avoid this, stick to your strategy, wait for pullbacks to support levels. So for me, the trading strategy that I'm using, I have a rule that I only buy at support levels. And to define those, you can use various tools. And again, more specifics on the strategy that I'm using, but you find various technical indicators, you find confluence of a support zone. If things break out and you missed it, wait for a back test of a support zone. Never buy outside of a support zone. So moving on, number 3, overtrading. So quantity over quality is not always a good thing. Overtrading, it's jumping into too many trades, chasing every market move, trying to recover losses or catch every opportunity. And it's a fast track to burning your account. Every trade carries risks plus fees and so on. The pros tend to trade less. They focus on high probability setups. And again, if your strategy requires you to make many trades during the day, then this might not apply, but there's some aspects that will. You certainly don't want to trade just to trade. If you're bored or if nothing's going on, you want to make a trade. Overtrading, it often comes from impatience or emotional reaction. So, a loss hurts. So you take another trade to try and fix it. Busy market feels like you have to trade. But more trades don't always mean more profits. They can often mean more chances to lose. So sometimes the best thing to do is do nothing. And if you're not trading yet, then you might not understand this until you've overtraded a little bit. Personally, I've made trades that I'm thinking, why did I trade that? I just wanted to make a trade today, and I didn't have a plan or it wasn't a good setup. And it's just leaves you having a trade that you kind of don't want, and then you sell out and so on. So to avoid this, you might want to cap your trades based on your clear strategy, or just focus on quality setups and just understand that there's always going to be opportunities in the market. It's not going anywhere. And again, you can make rules about this, or, stick to a strategy that has a allocation setup or strict rules about your entry. So overtrading, it's a thing. You might not know it until you actually start doing it. Number 4 here, ignoring risk management. So risk management, that keeps you in the game, but beginners often skip it, chasing unrealistic gains. So without good management, one bad trade can really crush your account. I see this all the time on X. People get over leveraged on a trade, and suddenly, it goes the wrong way and their whole account is wiped out. So, again, for your strategy, it might mean not using stop losses or risking too much per trade or aiming for crazy profits that don't match the market. So, whales and institutions, they manage risks like hawks, but retail traders, we often gamble, betting on a big single trade, hoping for a lucky break. And when it fails, the losses can be really harmful for our account. So, for me, I ignored risk management in the past, risking too much on a trade too early. And then, I'm allocated 10% on a stock that is retracing, and now I can't buy back in and get a better cost average. So allocating too much too early can make you miss other opportunities. So your better risk management to play it safe. Now, how can you avoid this? Just very strategic, specific rules for your allocation. So for my strategy, I can only risk 1 to 3% as an entry for a trade. And then I just want to stay patient and understand that retraces can come back. So aim for steady, 5 to 10% gains, not 100% moonshots. Again, your strategy is going to depend on this, but if you want to do it professionally, what I've noticed is that it's better to make steady, good trades rather than try to double your account, because that's unrealistic and something that over the long term, many years, you're probably going to fail and have a big loss rather than, a steady climb with good, strategic kind of professional trades. Now, my strategy, again, it states that building a position through accumulating good stocks at support zones is more powerful than trying to time the market. So accumulate at support and keep buying the back tests, scale in, scale out over the long term to maximize profit. So I'm looking for, you can think of it as little buys at support zones and accumulating good bullish charts rather than dumping a big allocation when I think something is in a good zone, because that's more risky. If it retraces, again, my cost average is too high, and so on. So risk management, no matter what strategy you are using, is really, really important. 5, just abandoning your trading strategy altogether. So a trading strategy, it's your blueprint to, make your entries and exits, but beginners often ditch it when the market gets tough. So maybe you doubt your setups, or something's at resistance and you ignore the rules, or it just feels like you're taking, 2 steps forward and like 1.9 steps back and things are slow right now. Well, without conviction in your strategy, you're basically just guessing. So the markets, they're going to test you out. The whales, they use news, they use narrative, social media, hype, and price action to just try and kind of shake out retail traders out of our plan. So if you don't stick to your strategy, you're dancing to their tune. You're basically in control. They are in control of your emotions and your trading, and you can't have that or you're going to lose. So for me, I lack some conviction at resistance levels. I planned trades and then I didn't follow through with them. So sticking to your strategy, having conviction is really important for you to follow along and not make mistakes. And again, I document and share my trades and my strategy in our school group. So if you haven't found one yet, you can certainly go over there and check them out or check it out. Okay, so number 6 is buying high, selling low. So the retail trader's curse is buying when prices are high and then selling when they are low. So green days feel safe. So we buy often at a resistance zone where prices then tend to reverse. And then red days, those feel scary. So we often, sell at support zones where prices tend to bounce. So it's really the opposite of buy low and sell high, but we get emotional and we tend to buy high and then sell low. And I've done this before. I think when Nvidia ran up, I bought at the all-time high was 142, and it retraced a bit, and I got scared and I sold, and then it retraced back, to I think like the 90s or 80s, and now it's on its way back out to all-time highs. But it's very easy to do when you haven't, when you're not aware of this stuff, when you haven't studied any trading stuff. I just, decided to buy at an all-time high, and guess what? It retraced back. So this happens because we tend to follow the crowd. Big players also exploit this, buying our panic sells and then selling into our FOMO buys, our fear of missing out buys. So our trades, again, as we mentioned, fuels some liquidity in the market. So how to think about this to avoid it? Well, you might want to take the contrarian view. So if the market's euphoric, you should be cautious. If it's panicking, you might want to look for deals. And we saw that with the whole tariff deals and Liberation Day, where the market, tended to tank. If you had cash in those positions, it almost V-bottom out of there. There were many deals, stocks like AMD fell to the mid 80s and now it's approaching 120, and so many examples like that. So when things are scary, look to buy potentially. When the market is euphoric, you might want to be cautious and take some off the table. Easier said than done for sure. But the best thing to do is to use technical analysis to find these support and resistance zones before making any buys. Buy near support, sell near resistance, and ignore the market's mood. So it's important to trust the charts. And again, if you're a beginner and you don't have experience, it's so easy to not do this. But once you learn this and you can kind of pull up a chart and say, hey, this particular stock, it's approaching resistance, now might not be the best time to buy. And then you can watch it retrace into a support zone. It's really, really good to watch when you get some experience. Lastly, number 7, lack of patience and discipline. So patience and discipline, they're the foundation of good trading. But beginners, we often lack both of them. We want quick wins, so we force trades when the setups might not be there, or we sort of abandon plans when the market tests us. So the market rewards those who wait, not those who act on impulse. And I can tell you, just from watching the market closely over the last 6 months, at times it's a really slow grind. It's a consolidation. It's up a little bit, then it's back a little bit, and then it's up. If you span out and kind of look in a year or 2 year time frame, many stocks are up quite a bit. But if you watch it day to day and you're impatient, you're going to make a lot of mistakes. It's very much, 2 steps forward and like 1.9 step backwards at times. And it's a slow grind. And sometimes the market does that to make you impatient, to make you make mistakes. And then it just gobbles up your money. So how to avoid this? Well, treat trading like a marathon, not a sprint. Wait for high probability setups, even if it means, no trades for a particular day or week or whatever. Build some discipline by tracking trades and reviewing weekly. So patience is your edge. Don't think you're going to double your account in a couple weeks or a couple months. Think more of using this as a profession. You're a trader. You're making a living in the future doing this, and you're just getting those consistent good trades in week over week, month over month, year over year. You don't need that doubling your account mentality, because that's going to get you in trouble. Patience and discipline. So, these 7 mistakes, emotions, chasing the breakouts, overtrading, ignoring risk management, abandoning your strategy, buying high, selling low, and lacking patience, they are traps that every beginner retail trader faces. I've fallen into many of them, but it's important that I'm aware of them. And when I do it, I can say, hey, I'm making a mistake here. I've got to refocus. I can stop myself before things get out of control. So I'm still learning, but the key is to turn these mistakes into lessons. You're going to make mistakes. You're going to lose money. You need to do that to gain some experience and to really have these lessons sink in. Sometimes, lessons from a podcast or from a book don't sink in until you really experience them. So you might want to, the best way to start this, if you have a strategy or you haven't found a strategy, start with a trading plan, have some rules for your strategy. The one that you're following hopefully has a few set rules that you can kind of follow along. And then if you don't have a strategy, you can certainly come to our school group. I explain more about mine. In the future, I'm going to have more tutorials about my specifics on setup and strategy. But if you're trading right now with your own strategy and you need a place to come and maybe be accountable or document your trades, then certainly consider our school group. You can kind of come here, have a thread, track all your trades, share everything. And you might find that useful. You might find that helps you avoid some of these mistakes. So thanks so much for listening. I hope that you found this podcast useful, and we will talk to you in the next one.